Hi everyone. In our previous classes, we have discussed about the topic ratio analysis. We have discussed about 5 marks problems on all sort of category of problems, that is liquidity ratios, solvency ratios, profitability ratios and turnover ratios. We have solved 5 marks problems on all of this. Now in this class we shall solve 15 marks problem. 15 marks problem is not a different problem. All the club of all these 4 categories, that is liquidity ratio, solvency ratio, profitability ratio and turnover ratio, the combination of all these 4 will come as a problem for 15 marks. Let us solve one problem on that. This is the question. From the following we need to calculate liquidity ratios, solvency ratios, profitability ratio, turnover or velocity ratio. There is a balance sheet given that is for the information. Let us quickly go through this balance sheet. Let us go through the asset side first. Land and building is a fixed asset, that is a non-current asset. Plant and machinery again it is a non-current asset, that is it is a fixed asset. Stock, debtors, accrued income, prepaid expenses, marketable securities, cash at bank, all these are called as current assets. Preliminary expenses, it is not a current asset. Now coming to the liability side, equity share capital, it is the share capital provided by the equity shareholders. Preference share capital, it is provided by the preference shareholders. Profit and loss account, it is the profit earned by the company because it is given on the liability side. So we can say it is a profit that the company has earned. 12% debentures and 8% long-term loans are called as long-term debt. Sundry creditors, bank overdraft, outstanding liabilities, provisions for taxations and proposed dividend are called as current liabilities. So if you look over here in the liability side, there is a one line item for provisions for bad debts. Now what is this provisions for bad debts means? A provision has been created for the bad debts which may occur in the future time. So here what we will do, from the debtors, that is from the asset side, the debtors value is 1,60,000, but on the liability side provisions for bad debts is 20,000. So in this problem what we will do, we will consider debtors value after deducting this provisions for bad debts, that is debtors 1,60,000 less provisions for bad debts 20,000. The remaining value, that is 1,40,000, will be treated as the value of debtors in this whole problem. So apart from this, there is an additional information given, that is sales, that is all sales is credit sales, that is 24 lakhs. Gross profit is 4 lakhs. Net profit before tax, it is clearly mentioned that the net profit what it is mentioned here is before tax. The amount of net profit before tax is 2 lakhs. Rate of taxation is 50%. Now if we subtract this rate of taxation from net profit, we will get net profit after tax, that is 2 lakh less 50% of net profit, that is 2 lakh, which will come to 1 lakh. 2 lakh minus 1 lakh of tax, if we subtract, the remaining value is 1 lakh, that is called as net profit after tax. So this was the question. So from this question we have to calculate liquidity ratio, solvency ratio, profitability ratio and turnover or velocity ratio. Now let us calculate each of the ratios one by one, starting with first liquidity ratios. In liquidity ratios, there are 4 sort of ratios which we can calculate in this problem, that is current ratio, quick ratio, absolute liquid ratio, as well as stock to working capital ratio. Let us solve one by one. What is the current ratio? Current formula for current ratio is current assets divided by current liabilities. If you see this table here below, the table says that it is a working note. It is a working note prepared for this current ratio. That is, all the current assets we have taken on one side, all the current liabilities we have taken on another side. So we have taken the total of that. In this problem, he has not specifically provided as current assets, but he has given a list of current assets. So altogether, if we add the total of current assets, the value will come to rupees 6,20,000, and the value of current liabilities will be 4,40,000. The same thing we have to interpret in this formula, that is current assets divided by current liabilities. In the place of current asset, I will write 6,20,000. In the place of current liabilities, we will write 4,40,000. So after dividing it, we will get an answer that is 1.41:1, which means our current assets are 1.41 to the ratio of current liability is 1. So these both are going on parallel basis. Current assets are 1.41, current liabilities are 1. So this was related to the current ratio. Now the second ratio is quick ratio. The formula for quick ratio is quick assets divided by quick liabilities. Here, quick assets means the assets which can be liquidated into cash quickly, that is quicker than the current assets. The normal time required for current assets to liquidate into cash is, we say, 1 year, which the assets which can be liquidated into cash within 1 year are called as current assets. Now here we want the assets which can be liquidated into cash within quicker than the 1 year. That is, so hence we subtract stock and prepaid expenses from this, because we are not sure when the stock can be sold or when profit can be made out of that. And even for prepaid expenses we need time, so when that time comes then only that maturity will be there. So hence, to get quick assets we subtract stock and prepaid expenses from current assets. That is, from 6,40,000 we are subtracting 3,40,000. So the value of quick assets is 3 lakhs. What about quick liabilities? The current liabilities minus bank overdraft minus cash credit will be quick liabilities. So in this problem we have the value of current liabilities, we have the value for bank overdraft, but we don't have value for cash credit, so hence we can keep it as 0. So the value of current liabilities is 4,40,000 minus bank overdraft 1 lakh minus cash credit 0. So the value will be 3,40,000. So if you interpret this information in the formula, that is 3 lakh divided by 3,40,000, so the answer will be 0.88 is to 1. That is, our quick assets are 0.88 is to quick liabilities 1. So the third ratio is absolute liquid ratio. The formula for absolute liquid ratio is absolute liquid assets divided by quick liabilities. What is this absolute liquid assets means? Here the assets which can be converted into cash at right that moment, which can be absolutely liquidated into assets, that is into cash right that moment, those sort of assets we consider over here. So the formula what we use over here is cash in hand plus cash at the bank plus marketable securities. So the values what we have here is 40,000 plus 80,000, together it will come to 1,20,000. that is our absolute liquid assets. Quick liabilities we have already calculated, that is current liabilities minus bank overdraft minus cash credit, so the value will be 3,40,000. So the same thing we interpret in this formula, that is absolute liquid assets divided by quick liabilities. 1,20,000 divided by 3,40,000. So the answer will be 0.35 is to 1. Fourth sort of category, stock to working capital ratio. Now the formula is stock divided by net working capital into 100. Stock is given in this formula. If you go to the balance sheet, that is mentioned as stock, rupees 3 lakh. What is net working capital? Net working capital is current assets minus current liabilities. So current assets what we have here is 6,20,000 and current liabilities is 4,40,000. So the answer is 1,80,000. Now the same thing we have to interpret into the formula. 3 lakh divided by 1,80,000 into 100. This will be expressed in terms of percentage, that is 166.67 percentage. This shows the result as stock is 166.67 percentage of net working capital. So these ratios were related to the liquidity ratios. Now let us go to the next ratio, that is leverage or solvency ratio. In the examination we may see the word leverage ratios or we may see the word solvency ratios. So hence I have mentioned solvency in the bracket. Here we need to calculate proprietary ratio, equity to fixed assets ratio, equity to current assets ratio, current liabilities to shareholders fund ratio, debt equity ratio, as well as capital gearing, that is it is also called as leverage ratio. Let us calculate one by one. Proprietary ratio. For the proprietary ratio, the formula is shareholders fund divided by total asset. Now here we have to prepare two working notes, that is one for calculation of shareholders fund, another to calculate total asset. If we consider shareholders fund, the formula will be equity share capital, preference share capital, reserves and surplus, profit and loss, less these preliminary expenses. This is the formula for this. If you interpret the values over here, the answer what we get is 8,80,000 as shareholders fund. What about total assets? Total asset doesn't mean all the assets. Total assets means all assets except fictitious asset. So from this we are subtracting the fictitious assets. We are considering only the assets. So total of assets will be 16 lakh 20,000. Now this thing we have to interpret in this formula, that is shareholders fund is 8 lakh 80,000 divided by total assets 16 lakh 20,000. So the answer what we get over here is 0.54 is to 1. That is the shareholders fund is 0.54 and the total assets is 1 in this ratio. The second ratio is equity to fixed asset ratio. So the formula will be fixed assets divided by owner's equity into 100. So here again we are preparing two working notes, that is one to calculate fixed assets and the other to calculate owner's equity. So fixed assets in this problem are two assets, one is land and building, another is plant and machinery. So total of this will become to 10 lakhs. What about owner's equity? It is very much similar to the shareholders fund, but here as the term equity is used, so we do not include preference shares for this calculation purpose. In shareholders fund we use equity share capital plus preference shares capital, but for owner's equity we have to consider only equity share capital. So the same formula is considered here. So total of owner's equity will be 6 lakh 80,000. So we interpret this in this formula, that is fixed assets is 10 lakh divided by owner's equity is 6 lakh 80,000. So the total will come to 147.06 percentage, which means fixed assets are 147.06 percentage of our owner's equity. Next is equity to current asset ratio. Here the formula will be current assets divided by owner's equity. The current assets we have already considered, that is the value of current assets is 6 lakh 20,000. Owner's equity also we have already calculated, that is 6 lakh 80,000. So if we interpret these values in this formula, that is current assets 6 lakh 20,000 divided by owner's equity 6 lakh 80,000, the answer what we get is 0.91 is to 1, which means our current assets are 0.91 to the owner's equity, that is 1. Next is current liabilities to shareholders fund ratio, which means current liabilities divided by shareholders fund. Current liabilities we have already calculated, even shareholders fund we have calculated. We are just showing that working note once again over here. That is current liabilities 4 lakh 40,000 divided by shareholders fund 8 lakh 80,000. So the answer is 0.50 is to 1, which means our current liabilities are 0.50 is to shareholders fund of 1. Debt equity ratio, the formula is external equities, that is long term debts, divided by internal equities, that is the shareholders fund. External equities, that is 12% debentures we have, as well as 8% long term loan, that is the long term debts we have here. So together it will come to amount of rupees 3 lakhs. Shareholders fund, the amount of shareholders fund is 8 lakh 80,000. So you have to interpret these values in this formula, that is long term debts of 3 lakh divided by shareholders fund 8 lakh 80,000. So the answer what we get over here is 0.34 is to 1, that is our long term debts are 0.34 of our shareholders fund of 1 rupees. Next, capital gearing, that is the leverage ratio. Here we are considering about fixed interest bearing securities. These fixed interest bearing securities are for long term debts. It deals with the long term. Divided by equity shareholders fund. Equity shareholders fund is nothing but owner's equity. So now here long term debts what we have, that is which are giving fixed sort of interests or dividends. So here we have in this problem 12% debentures, which provides 12% interest on per annum basis, and we have 8% long term loans, which provides 8% of interest fixed. Even we have preference shares capital who receive a fixed dividend, that is 8% of the 2 lakh rupees. So here we consider these three items as long terms. So the total will be 5 lakh, that is fixed interest bearing securities are of 5 lakh rupees. Equity shareholders fund, that is owner's equity, will remain again 6 lakh 80,000. So 5 lakh divided by 6 lakh 80,000 is 0.74 is to. So these were related to the leverage ratio, that is the solvency ratios. Now let us solve next sort of problem, that is profitability ratios. In this profitability ratios there are two categories. profitability ratios relating to sales and profitability ratios relating to investment. So first let us solve the profitability ratios relating to the sales. So the ratios what we can solve here is gross profit ratio, operating ratio and net profit ratio. In this we can calculate expenses ratio as well as operating profit ratio, but for this problem we cannot calculate this because the information what we require to calculate expenses ratio and the information what we require to calculate operating profit ratio is not given in this problem. Hence we are not able to calculate these two ratios. So let us solve one by one. Gross profit ratio. The formula for gross profit ratio is gross profit divided by sales into 100. Both the informations are given directly in the question, that is gross profit is 4 lakh rupees and sales is 24 lakh rupees. So we can interpret this value in this formula. 4 lakh divided by 24 lakh into 100. That is 16.67%, which means our gross profit is 16.67% of our sales. Next ratio, operating ratio. Here, cost of goods sold plus operating expenses divided by sales into 100. This is the formula. Let us first calculate cost of goods sold here. The value of cost of goods sold is sales minus gross profit. That is 24 lakh minus 4 lakh. That is 20 lakh will be the cost of goods sold. Next, for calculating operating expenses, we have one formula here, that is gross profit less non-operating expenses. Now in this problem, the information related to non-operating expenses is not given directly. We have to identify that. That is the interest what we are giving for our debentures, for our long-term loans, for the bank overdraft. These three things we have to subtract as non-operating expenses. And apart from this, we subtract net profit from the gross profit to obtain the operating expenses. So if we use this formula, we can get the operating expenses value, that is 1,56,000 rupees. So together these both will be help us to calculate operating ratio, that is 20 lakhs plus 1,56,000 divided by 24 lakhs into 100, that is 89.83% is our operating ratio. Next, net profit ratio. Here we have calculated net profit in both the ways, that is net profit before tax as well as net profit after tax. Let us see one by one. Net profit before tax, he has clearly mentioned that 2 lakh rupees. 2 lakh divided by sales 24 lakh into 100, the answer will be 8.33%. This is before deduction of the tax. Second sort is net profit after tax, that is 1 lakh. The net profit what we have is 2 lakh and the rate of taxation is 50%, which means 50% of 2 lakh, which will come to 1 lakh. So here in this working note we have shown net profit minus rate of taxation, that is 2 lakh minus 1 lakh, and the remaining value of 1 lakh is the net profit after tax. So this 1 lakh we are interpreting in this information, 1 lakh divided by 24 lakh into 100. So the answer will be 4.17%. So next sort of ratio is profitability ratio, but they are related to the investments. So in this problem we can calculate three sort of ratios, that is return on capital employed, return on proprietor's fund and earning per share. What is return on capital employed? The formula for this is net profit before tax divided by capital employed into 100. So here we have shown working note for capital employed. Net profit before tax is anyhow directly given in the problem. So here we are showing a working note for capital employed. So how to calculate this capital employed? The first way which we can calculate is fixed assets add current assets less current liabilities. One more formula for the same is fixed assets add working capital. So here if you see the addition of current assets and subtraction of current liabilities, this is the formula for working capital, that is working capital is equals to current asset minus current liabilities. So either we can add working capital or we can do in this fashion, that is fixed assets plus current assets minus current liabilities. So from this formula we obtain the capital employed value of rupees 11,80,000. If we interpret this information in the formula, that is net profit before tax is 2 lakh divided by capital employed is 11,80,000. So the answer what we get is in the form of percentage, that is 16.95%. Next is return on proprietor's fund. So the formula will be net profit after tax divided by proprietor's fund into 100. So net profit after tax is, net profit is 2 lakh. From that we subtract the tax, that is 2 lakh into 50% is 1 lakh. So total of net profit after tax will be 1 lakh rupees. Proprietor's fund. So the proprietor's fund formula is similar to your shareholders fund. Proprietor's fund is equals to equity share capital plus preference shares capital plus reserve surplus plus profit and loss minus preliminary expenses. So total will be 8,80,000. If you interpret this information in the above formula, that is net profit after tax 1 lakh divided by proprietor fund is 8,80,000 into 100. So the percentage what we get over here is 11.36 percentage. Next is earning per share. The formula for earning per share is net profit after tax divided by number of equity shares. That is, in this problem, the net profit after tax is 1 lakh rupees and the number of equity shares are 4,000 shares. So if you subtract that 1 lakh divided by 4,000, the answer what we get is rupees 25 per share. The next sort of ratios are turnover, or we can call it as activity ratios. So here we can calculate stock turnover ratio, debtors turnover ratio, average collection period, creditors turnover ratio, and average payment period, working capital turnover ratio, fixed assets turnover ratio, capital employed turnover ratio. All these sort of ratios we can calculate. Let's calculate one by one. The first is stock turnover ratio. The formula is cost of goods sold divided by average stock. Here the cost of goods sold can be calculated by the simple formula, that is sales minus gross profit, that is 24 lakh minus 4 lakh. So the cost of goods sold is 20 lakhs. The formula for average stock is opening stock plus closing stock divided by 2. There is a note mentioned here. The note is related to the average stock. In this problem, there is no opening stock given, but we have a closing stock. Hence we can assume that closing stock itself as the opening average stock. So hence I can interpret it as average stock is equals to closing stock, that is 33 lakhs. We will interpret these values, that is the cost of goods sold value and average stock, into this formula, that is cost of goods sold is 20 lakh divided by average stock is 3 lakh. So it says 15 times, which means the stocks has been turned over into the company 15 times. That is 15 times the stock has been bought and been sold. Next is debtors turnover ratio. The formula for debtors turnover ratio is net credit sales divided by average receivables. What is this net credit sales? The formula for net credit sales is sales minus sales return minus cash sales. So in this problem, the sales value is 24 lakhs and we have not information related about sales return and we don't have information related to the cash sales, so we cannot subtract anything out of it. So net credit sales value will be 24 lakhs. What about average receivables? What is this average receivable? The average receivable is equals to opening debtors plus opening bills receivable plus closing bills receivable plus closing debtors, whole divided by 2. But again in this problem, opening debtors or bills receivable is not given. So hence we can assume that closing debtors itself is an average receivables. So hence we can go ahead with it. That is 1,60,000. We will interpret these values in this formula, that is debtors turnover ratio 24 lakh divided by 1,60,000, which will again come to 15 times. Average collection period. Average collection period is equals to number of days in a year divided by debtors turnover ratio. That is 365 days divided by 10 times. The answer will be 24.33 days. If the same thing if you want to calculate for weeks, that is average collection period in weeks, number of weeks in a year divided by debtors turnover ratio, that is 52 weeks are there in 1 year, 52 divided by 15, which is equals to 3.47 weeks. Average collection period, number of months in a year divided by debtors turnover ratio, that is for in months. 12 months will be there in a year, so 12 divided by 15 times, which will be 0.8 months. So next sort of ratio is creditors turnover ratio. The formula for this is net credit purchase divided by average payables. So the formula for net credit purchase is not mentioned here because in this problem the net credit purchase is not given. So hence we can go this problem information relating to purchase is not given, hence we can assume net credit purchase is equal to cost of goods sold or sales. That is, we can assume cost of goods sold is equal to the value of net credit purchase. So the value of cost of goods sold is 20 lakhs, that is sales minus gross profit. The value will be 20 lakhs. The formula for average payables is opening creditors plus opening bills payable plus closing bills payable plus closing creditors whole divided by 2. In this problem, opening creditors and bills payable information is not provided. So we can go ahead assuming that closing creditors as average payables, that is the 2 lakhs. So we can interpret these values in the above formula, that is net credit purchase is equals to cost of goods sold, that is 20 lakhs divided by average payables 2 lakh. So the answer will be 10 times. Next we need to calculate average payment period, that is in days, in weeks or in months. First we'll calculate in days. Number of days in a year divided by creditors turnover ratio, that is 365 days divided by 10, that is the creditors turnover ratio. So the answer is 36.5 days. For average payment period in weeks, 52 weeks divided by 10, the answer will be 5.2 weeks. For the average payment period in months, 12 months divided by 10, that is 1.2 months. Next is working capital turnover ratio. So the formula for this is sales divided by working capital. So the value of sales is 24 lakhs divided by the value for working capital is 1,80,000. That is, the sales is 24 lakhs. Working capital can be found out by current assets minus current liabilities. That is 6,20,000 minus 4,40,000. So the value is 1,80,000. 24 lakhs divided by 1,80,000 will be 13.33 times. Next is fixed assets to turnover ratios, that is sales divided by fixed assets. So here the information for sales is directly given in this problem, 24 lakhs, and for fixed assets we have only two fixed assets, that is land and building and plant and machinery. So together the value of fixed assets will be 10 lakhs and the value for sales will be 24 lakhs. So 24 lakh divided by 10 lakh will be 2.4 times. Capital employed turnover ratio. The formula for this is sales divided by capital employed. The value of sales is 24 lakhs and earlier we have calculated capital employed. So the same thing can be used over here. That is 24 lakh divided by 11 lakh 80,000. So the answer will be 2.03 times. So this was related to the ratio analysis 15 marks problem. So this ends this problem. So request you guys to go through all sort of exercise as well as illustration problems which are provided in your book, and if you have any doubt, please don't hesitate to reach out to me. You can reach out to me at any time. So I am asking you guys to solve all sort of exercise as well as illustration problems from your textbook, and one more additional problem I am mentioning on the next slide, so please go ahead and take down and try to solve that problem. So this is the problem, from where you need to calculate liquidity ratios, solvency ratio, profitability ratio and turnover ratios. So here we have balance sheet, trading and profit and loss account, and one more information related to the rate of tax, that is 50% is given. So now you guys try to solve this problem, as well as apart from this problem solve from your textbook all exercise as well as illustration problems, so that you will be perfect for the examination. And don't hesitate to ask any sort of doubts at any moment. Thank you.